Excellent. Hello, everyone, and welcome to the first ever C-suite Collab. For those who are tuned in and don't know me, my name is Dean Carroll, and I'm one of the co-founders of C-suite, which is a new startup aiming to provide a lifetime learning platform for executives and aspirants. Our Collab series of virtual events are an extension of our app, which you can check out at csuite.sg, and that's C-suite with a hyphen. As a user, you'll be able to view what's happening in the app, and then if you like what you see, you can sign up as a paying member in order to participate in the community. There you'll find great content plus great connectivity. You can even engage in professional matching if you're looking for a mentor, co-founder, investor, board member, and so on. In addition to that, you can create your own content and become a thought leader while also benefiting from the other high-profile members sharing their knowledge too. So back to the matter in hand. Today, it's our pleasure to host a panel of 15 experts, including investors, founders, and mentors. In very much a free-form manner, they and you in the audience together will explore the timely topic of startup fundraising, the hard truths you need to know during COVID-19. We really do want to see a two-way dialogue today, so please get involved with questions from the floor and do vote in our online polls. This is not the traditional event structure, therefore if you're a founder, you can even do a 60-second elevator pitch for your startup, and if an investor wants to match with you, C-suite will connect you up afterwards. So to be in the mix to get picked, please put your one-sentence startup descriptor in the chat box now or anytime throughout this evening, and we will pick out the most interesting ones. You'll then have 60 seconds to do your elevator pitch, and the audience will vote afterwards on whether they would invest. We will then ask the panel for their thoughts on the business. So before we start, just a quick housekeeping note to say you can submit questions via the Q&A icon, and we will try to answer as many of those as we can today. Feel free to remain anonymous or leave your name and company there too if you'd like it to be name checked. In addition to that, you can obviously comment and talk to each other in the chat box, but of course we would ask that you remain respectful and professional when doing so. Thank you very much. Now, let's kick off with a question to the panel to get things moving. And the question is, what is the most important factor you want to see when investing in a company? Is it the vision, validation of the idea, the founders, revenue, traction, or something else entirely? And I think if it's okay, we'll kick off and start with the Golden Gate Ventures managing partner, Jeffrey Paine, on that one. Jeffrey, if you're there, what's the key to unlock your door?
Well, your question is, what's the first thing?
So the question is, what is the most important factor you want to see when investing in a company?
I'm speaking as a VC. Sort of the number one thing is market size. Then the team. Yeah.
Okay. And market size in terms of just scale or demographics or territories?
How big you will be. So it can be, you're global from day one, regional from day one, or you are doing 5 things in one country. It doesn't matter. You have to explain to me how big you can be.
Okay. Okay. And that outweighs everything else for you, Jeffrey?
Yes. Because in our business, it's about returning, a lot of money to our investors. So So we are not an angel. We are not your family. We are not your friends. We are not your ex-bosses. We are not your parents. So we need to return money. So that's the first thing.
Got it. So it's about taking the gamble and the emotion out of the decision. Right. Interesting. Okay. And Jiawen, you're a founder who has built companies actually and navigated multiple exits. In your experience, what's the most important factor for investors?
Yeah, I think just adding on to what Jeffrey said, investors are generally different in the sense that if you're an angel investor, you may have very different returns that you're looking at, and you may also be diversified in a different way. And being a founder who exited my own business, did a bit of angel investing, and back in the entrepreneurship game, I think for me, given my profile, the most important thing, a little bit biased here, is team. And secondly, because of the stage that I typically enter at, valuation. And to talk a bit more about that, team, because I think the founder effect and the ways, the influence and the ability for founders to grow a company and to rise up against challenges. I think these are things that determine the longevity of a company. Towards through thick and thin, and valuation, because typically angels come in at a very early stage, and there is a lot of dilution downstream, and depending on the returns that they are trying to get, there are certain valuations that are just off the table for an angel.
Got it. Okay, that's a very interesting point. And when you talk about the team, how much of it is about experience? How much of it is about mindset? How much of it is about individuals that are greater than the sum of their parts? Because I think what I've heard from investors, right, is they want to see a team full of experts, but they also want a team that's willing to pivot and be agile and go where the dollars are, right? So has that been a key factor in your experience as well?
I think there are different type of founders, and the truth is that I don't think I know the answer, or anyone knows the answer out there. There are founders that seem to be very attuned to the heartbeat of the market, and they always land on their feet, but they may always just end up with a 5 to 10 mil type of business instead of building a unicorn. And there are founders who can be very stubborn to the mission, and just laser focused on the mission at hand, regardless of what the market says. And sometimes they are punished, sometimes they are rewarded. So I think at the end of the day, a lot of it is also timing, luck, a mix of skill and experience. It's hard to point down to one factor.
Got it. Okay, well, perhaps we can ask a fledgling entrepreneur what they feel is important. So Anastasia Evans, you're a startup founder at Kuyo, and you were previously on the Antler Accelerator program. So what are you focusing on in your pitches? What do you see as important from your perspective?
Well, I think to answer the question generally, what investors look for depends on the stage of the business that you're pitching. We are kind of MVP stage right now, pre-seed levels, talking to angels. And so what our investors are looking for is going to be vastly different to what someone like Jeff is looking for. So we are fundamentally focused on our team dynamic, our expertise in the industry, which is marketing and advertising, and then also the mission and how it's kind of a vital business for right now. Our business is kind of predicated on the fact that we are on the precipice of this cultural change, right? So the pandemic has brought about all of these changes in the world, and we're kind of tapping into that right now. And so that's the kind of fundamental core of what we're talking to investors about right now.
Interesting. Okay. And let's jump back to the other side of the fence then. In fact, someone who's seen it from both sides of the fence, Steve Melhuish, you were first as a founder of the Unicorn Property Guru, and now as a venture partner at Wavemaker. In your view, what are the things most important to investors in what they see in a startup?
For me, it's about solving a big pain. Is there a big problem that needs to be solved? And I guess, is there evidence that the timing is now? Because quite often you could have a big challenge, an opportunity you want to solve, but the fundamentals of the market are that you're too early or you're too late. So is it a big pain you're trying to solve? If it's a brand new business, then all you can really look at is what's the problem that people are trying to solve, and who's trying to solve it. In other words, the founders. Are the founders the one you want to back to be able to solve this? If it's a later stage business, then you have a little bit of evidence around traction and therefore maybe go-to-market fit, which you can kind of rely on. One of the things that's come out from analysis and data that we've done at Wavemaker particularly has been around companies getting to a certain stage, but then not scaling beyond that. And one of the key criteria around that is, it sounds obvious, but it's the ability of the founders to build a team which will enable it to scale. So can they hire and retain and develop a leadership team, which means they can delegate and hold accountable? There's obviously, that's that you can look out for a little bit in later stage businesses. But those would be the three. So big pain, traction if it's a little bit later stage, and then founders and the founding team and the passion in the founding team.
Got it. Yeah, as someone who's been building a founding team over the last few months, I definitely see that as a key. Yeah, great people can do great things, right? Yeah, definitely. Okay, so I think final word on this goes to the Slash Ventures CEO and co-founder Andries de Vos. Andries, I know when we've talked previously, you've reiterated to me how important validation of the idea is. And I know you do a lot of work in that space as well with Slash. So is that the most important thing in your view, or is it just one of one ingredient in the recipe that needs to come together?
Well, it's definitely one of the key. But we come in at a very early stage. We typically come in sort of at a $2-3 million valuation. So basically as the first investor, as a venture builder. So one of the criteria we look for is market access. So we look for B2B entrepreneurs that have already sort of a key clients lined up to de-risk the venture within the first year. And that assumes that they already have some kind of validation of their idea. So that's usually something we look for indeed, because it just de-risks, especially for SaaS business and B2B businesses or enterprise. We do a lot of enterprise. It's important for us to know that we can, within a reasonable time frame, with a short sales cycle of, let's say, less than 12 months, get to marquee clients. And that really means that we typically look for founders who come from a corporate background, between 35 and 50 years old, who have a lot of experience in their domain, and who are venturing out on their own, but they already have some kind of validation because they've been operating in that environment for a long time in their corporate careers. So we have a very kind of narrow focus in that sense. But in a broader sense of the word, yes, I think early stage validation is extremely important. Obviously, big market, big pain is all there. Validation sort of links to big pain, but having some kind of evidence early stage that you can it's worth investing a huge amount of money for an MVP or for a version 1 is something we look for indeed. Yeah, so we try to de-risk that early on in the first sort of 3-4 months of our engagement with someone.
That makes sense. And it sounds very much like you believe in the academic research that is out there, peer reviewed, by the way, that says, the average age of a successful founder, despite the Hollywood stories that are out there, right, is actually 45. So it sounds like you subscribe to that school of thought as well.
I think there's many ways to build a business. I think entrepreneurs comes in need in many shapes and sizes. I would echo what Jiawan was saying on this. But I think the game we're playing is we look for experienced operators, so that we don't have to tell them how to run a business or how to necessarily address their market. I think there's a game to be played with early stage, with entrepreneurs that are much younger, and then to equip them with certain key skills, and then assume they're hungry enough and they can figure things out on the road. We look for more mature people, but I think both can work. I think one of the advantages of our approach tends to be that because of the type of people we work with, entrepreneurs we work with, they already have a lot of evidence that there's a market for it. And that makes a huge difference. It may not become a unicorn, but we know that even if things were to go wrong along the way, there's already quite a lot of salvage value in their IP, because worst case, they can sell it to their ex-employer. To put it simply, right? So in that sense, there is a number of exit paths for us, including, hopefully, success.
Got it. Okay. Well, listen, anyone else that's on the panel can jump in at this stage. I've definitely got questions for all of you throughout this evening, but does anyone else feel passionately about this question and want to jump in with their insights or thoughts?
I'd just add one thing. Hey, Dean, it's Andrew.
Oh, yeah.
Well, I can add a few things, but I think they've already been covered. But one of the most important for me wearing investor hat is how quickly and how clearly you ask me for money, which I think I spend a lot of time hearing vision, story, why there's disruption, or why you believe there's disruption potential, and it never really gets to why I'm sitting there. And that for me is slightly off-putting, because in terms of coming back to the importance of the team, you're going to be selling a product, or a service or a solution. So you need to be able to do that and ultimately ask customers to pay you for that and therefore generate revenue. So I think that sort of skill, the ability to have that conversation early, clearly, and then frame the mission, the position of the company within that is actually something that is overlooked often by startups or scale-ups, actually, at various different levels. And then the echoing, I think, Andreas' point, and coming back to Jeff's point on market size, for me, it's all about what the potential customer has said to you. If you tell me that the market for global video demand is 750 million potential subscribers paying $10, that's potentially fine, but how many of those have you spoken to? What's your route to that? How many have indicated that they would actually buy what you're doing? Now, of course, if you're very early, you've got to run on the assumption that people will. But again, surprisingly often, companies, less so in the enterprise space, spin-outs from corporates and so on, but surprisingly often, no one has actually spoken to customers in depth or detail, or thought about having attributed comments or attributed support, or even indeed entered into LOIs and so on to try and give some credence to, if we build it, they will come. And then the team, coming back to that last point, we can all, putting the early stage investor hats on, you can all take market risk. It's sort of our job to assess whether we believe your story and there is a business that will grow. But what we can't take is people risk. So I think personally, I would invest a lot of time in how that dynamic works, how they interact, how they've thought about how they establish themselves as between themselves in terms of incentives. And that also comes back then to deal structuring and what people are asking for money-wise. Is the team willing to back itself and earn into the deal? So give away a higher percentage of the company up front, but earn back in because they're backing their delivery against the business plan. Have they already agreed retention mechanics between themselves? So if someone leaves, there's a rejigging of equity positions. Stuff like that, I think, is what I think about when I look at a team.
Got it. Really,
actually, Dean, yes. Hi, could I say something?
Oh, hi, Christel. Yeah.
the other Christel.
Yeah.
And thank you so much for having me today. And a pleasure to see so many wonderful, familiar faces. Belinda, Perry, Steve, so on and so forth. Mohan as well. I think I wanted to add something as well, which probably may echo in some minds here, right? Is that there is a sea of financing available for many companies and startups, right? I mean, you have debt financing, equity, right? So I think in a world where there's so many venture capitalists, we need more venture builders together with companies as well. So you are going to put in money into my company, right? What can you also bring to the table that's going to be strategic in nature as we explore how we adapt the business, sort of resize the market, look at a better product market fit. And in the entrepreneur itself or the founding team, they need to have enough grit and adaptability. You can be proud of what you build, but not proud of yourself. I think that's also something that I'm thinking about as I listen to these responses, right? So yes, more venture builders, less venture capitalists. I wouldn't say but basically the cost of capital for us companies is really, really high. When you think about the ways where we have to either look at giving up equity or, look at cost-effective financing solutions to expand our business. And it's tough, especially in this post-COVID world. So we want to also be able to explore how we can work strategically with, people who are able to finance us, right? And finance our market expansion. Yeah.
That's a good point, yeah.
Dina, I'd like to jump in there a little bit. Hi, everyone. Hello from Berlin. I'm an old friend of Dean's from London from way back. Thanks for having me here. So I run Techstars here in Berlin, but I'm also a partner in the fund. I want to take a slightly contrarian approach here because I think we can all talk about founder market fit or having market sizing figured out. We're at the end of the day, we're investing in outliers, right? Like we're looking for those outsized returns that come as a result of taking bets. And so let's not kind of lose track of why we got into this in the first place. You could look at team risk, recruiting risk, sales risk. There's risk all around. At the end of the day, at the stage that we're investing in it, and we run an accelerator, so and then we do follow-on funding in some of the companies that come out of our programs. Companies like ClassPass, Faro, Twilio. The point I'm trying to make is that I think we end up going in circles, and so we could start trying to identify a perfect typeset or a persona of an entrepreneur, and then just invest in those. Or you can actually say, because we're looking for outsized bets, we've got to do a little bit more work. And to oppose Christel's point, I think a good venture capitalist is a venture builder. You don't need a venture builder separately from a VC. I mean, most of the VC funds that we are recommending are the ones that are going to be rolling up their sleeves and doing the work. I mean, I'm in board meetings until like 3 a.m. sometimes. We don't need a venture builder to do that. Like a good venture capitalist should be able to do that themselves. So, love to hear Jeff's thoughts on that.
Jeff, would you like to respond?
No, I think VC is like a financial co-founder to founding teams, right? So I think I liken to say VCs are kind of we are incentivized to learn new things, which very few jobs are like, right? So if you think about your former jobs, if you study something in quantum mechanics, you're probably gonna get fired because you're not focusing on your work. So that's one. The other thing is we are also a part-time psychologist to most of our founders, right? So there is the the blocking and tackling that you can help advise, and then there is also the emotional side of things that actually many founders don't talk about. So we are all there we have their backs at all times. So that's one. And for outliers, yes, 100%, right? That's how we continue to do what we do. Hence, not all startups or /SMEs need VC money. You guys need to know the alignment and what we're looking for and where you'll be in 12 years versus what we want you to be in 12 years. If it's not aligned, then you don't take money from us. It's very simple, right? I'm not saying if you cannot raise VC, shut down your company, right? If you can run the business as the way you want to run it, then go ahead and do it. Find the right investors that align with you.
Yeah. Okay, I think that point about having a founder's back is really important as well, right? Because it can be a very lonely place as a founder, if you don't have that support network. So thank you for raising that. So I think before we change topic, let's ask the audience what they think with our first poll question of the night. And the poll question is, what is the most important factor you want to see when investing in a company? And the options are, for those watching on catch up, not live: idea, validation, founders, revenue, traction, or other. So I think we'll give people around 30 seconds to vote. So please get voting now. Click on the option you want to choose there, and let's go. Christel, who's our operations manager at C-suite, is also on the call. Christel, is it working okay?
Yep. Yeah, I'm sitting it good.
I'm not seeing the numbers change on my screen, that's all. Okay. All right. So we'll give it 5 more seconds. Okay, let's call it there. So the answer is 31% say the idea, 15% validation, founders 23%, revenue only 8%. That's surprising. Traction 19%, other 4%. So if you voted other, perhaps do us the favor of jumping in the chat box there and telling us what your other was. That would be much appreciated. Thank you for that. Okay. So as a gentle reminder for the founders out there that are tuned in, if you want to do your elevator pitch, whereby you'll get 60 seconds to pitch your company, and then the audience will vote afterwards whether they would invest or not, and the panel will have some feedback for you, hopefully. Please do leave your one-sentence company descriptor in the chat box there. And if it sounds interesting, we will call on you to present. So come on, I see there are a lot of people tuned in rather. So please do be brave. We won't be eating you alive. It's a safe space, so please do jump in. Okay, so, oh, we have someone there from Luke Tai to all panelists. Enabling financial inclusion. Okay. So Luke voted for enabling financial inclusion for the unbanked in Indonesia. Oh, sorry, that's your startup, Luke. Okay. Let's just do our first question, and then we'll come back and we'll get Luke to do his 60-second elevator pitch. So Luke, prepare yourself. We'll come back to you soon. All right, now raising money for a startup is a gargantuan task at the best of times, but during a pandemic, it has to be 10x harder, you'd think. With that in mind, let's mine the panel now for their knowledge on the question of how has COVID-19 changed the optic when it comes to raising money? And I think, Jag, we'll come back to you again, first of all, on that one as MD at Techstars. I was looking at your LinkedIn profile, and it says you're one of Europe's most active investors, according to your LinkedIn profile. So I take it 2020 has been perhaps less active than normal, Jag? What would you say to that?
No, definitely not. In fact, we're doubling down. I mean, so I'm an angel privately. I'm also an LP in a bunch of funds, and actually in most of the funds, we're deploying capital at a faster rate. For us, there's two things at play here. One, there were a bunch of companies that were able to, so in one case, many companies that we'd already invested in, we were doubling down and making sure that they had enough capital to sustain themselves over the next year or so. In March this year, we were thinking that it would be super hard for any startup to raise money for at least 18 months. And then by July, the picture became a lot clearer, and it turns out actually it wasn't so bad. And then the second thing is actually that many of the companies that we're looking at, they were a little bit more realistic about their valuations. We're investing in pre-Series A or Series A, and there was at least a 20-25% decrease in valuations, which made them really, really attractive. So from that perspective, we were just buying the dip. But overall, we're seeing a ton of new deals come on the market, a ton of startups that may not have thought about how to survive a pandemic or recession. Founders are increasingly thinking about that, and that's good. Like that makes my job a lot easier because I'm less. I no longer have to be the kind of the devil in the boardroom to say, hey, look, what happens if you're not able to raise money? So founders are starting to think about that proactively, which means it's much more easier for a VC or an angel like me to be able to jump in on a good deal.
Got it. And by the way, Jag, I think you've got mirroring on your Zoom virtual background, so you're back to front. But
so it's weird because it appears fine for me. So I have no.
Right. Okay. This end, I think Christel and I can have to read it backwards. Yeah.
Okay. Does that work? Is that better?
No. But anyway, we'll come back to it. It's not a big deal. Not a big deal. It adds,
Zoom's the new Skype, right?
Yeah, adds to the rich tapestry of the evening, right? You need some things to go wrong. Okay, Mohan Belani, you run the TechCrest title E27 here in Singapore. and I know you're pan-regional too. I get your newsletter in my inbox every morning, and there still seems to be myriad investment activity right across Asia. But how has the landscape altered in your view during the pandemic? Are you aligned with Jag's thoughts on that?
Thanks, Dean, for having me, and it's good to be here. So for some context, right, like I also angel invest. I've been doing that since 2013. Earlier in funds and mostly in companies. And interestingly, 2020 has been the year where I've done the most number of angel investments in startups. So I think there's still a lot of opportunities in early stage deals. Yes, in the earlier parts of the year, companies that were looking at doing larger rounds this year, they either had to rethink their plans, they either had to pull back on some of these plans, or they had to focus on cost-cutting measures to extend runway, right? Because some of the fundraising plans were not going to come in. I also am aware of companies that have tried to raise money in challenging sectors, like, for example, the travel sector, where the VCs actually ended up committing and transferring the money and doing the deal through. So it's been quite a mixed bag. There was a report that came out that apparently in Q3, right, the fintech investments had rebounded back to well over 300 million in investments. So if you ask me, I think there was a slight pullback in the earlier parts of the year, where it was generally due to uncertainty and a bit of, and definitely fear. But I think it has definitely picked back up. In fact, I would agree with Jag. A lot of the smart investors are looking at opportunities where they are able to go in at reduced valuations, or they are able to actually do bridge deals with existing portfolio companies that have done really, really well, but just need that additional level of investment. And I personally think that 2020 is going to be a resurgence of companies forming up globally, a lot of it in the US. In fact, I just invested in the US, early stage tech fund in the US this year. And I think Southeast Asia is also going to see that happening. Because just like what happened in 2008, 2009, which we lived through, that was actually the boom period for startups forming up. And I believe actually that's going to happen exactly this year and next year.
Okay, so pain today, but hopefully success next year is coming for us all. Okay, Christel Quek, you run the blockchain-based media company Bolt, which has been going for 3 years now, I know. So question for me, are you still fundraising? And if so, has that been more difficult this year due to COVID-19 in terms of the investor conversations?
That's a great question. I think if you're a growing company and you stop, I mean, as an entrepreneur, you're always fundraising. In fact, I was just having this same conversation with Steve. I think it was 2 weeks ago. We were sort of sharing some insights, and I was sort of taking some of his advice, because as we all know, he's built an impressive company in the last decade or so. Really great track record. So, for us, we are always fundraising and also looking out for great strategic partners that, can really add value in terms of how they help us think differently about the business, grow in different markets, and also look at how we can add additional features that are going to make money for our investors and shareholders. At the end of the day, it's all about that, right? So, it's good to have a great idea, but execution is everything, and a creation is nothing without creativity and execution, as I like to say always. So yes, we are always and actively, happily fundraising, looking for great strategic investors. Bolt is still, pretty much predominantly owned. I would say more than 90% owned by my founder and myself, our founding team. And also we currently have already established commitments from incoming shareholders who are looking to take a higher equity stake in our company. In fact, actually, I do need to jump off in about an hour's time to speak to a couple of them. So that is the answer.
Money never
always
sleeps.
Be working, man. Yeah.
Got it. Yeah. Got it. Okay. And Fei Yao, like Christel, you two were in the Forbes 30 under 30, right? And you two have, this is to Fei Yao now. So, and you two have raised for your alternative business school company, NewCampus. So what changes have you witnessed this year in terms of the investment landscape, if any, Fei Yao?
Thanks, Dane. Thank you for inviting me here today. I'm happy to share a bit more about how we have looked at fundraising. What has been very interesting for us is that we are in a bit of a niche sector when it comes to this geography. So higher ed continuous learning is not something that is actively being done in Asia Pacific. So for us, a lot of the people that we have previously actually connected very well with and who have shown the most amount of interest and strategic alignment with both our product, our problem, what we're trying to build towards, tended to be from other markets, usually from the US and Europe. And one of the challenges that we actually faced before was that they don't invest in this part of the world. And we're actually starting to see that change. So that has been something that has been a positive effect of the pandemic, which is conversations that we wouldn't necessarily have had before are coming into much better fruition. And we see that, where the education landscape is heading towards is definitely much more global, and there's a lot more noise being made in our sector as well.
Got it. And finally, I just want to go to Ian Chapman Banks. You're the Scream Technologies co-founder, and you're currently doing a 30 million Series B round, I believe.
Yes.
So how's that going, Ian?
Yeah, we actually had all the documents ready for February, and of course, February and March were politely known as a kind of a meltdown, but the market stabilized very quickly, and we have a very large and profitable niche in the pharma business, and we also have some significant contracts with the US government intelligence agencies. So actually, our business came back very quickly. In fact, we will double our revenue this year on last year, and last year we grew our business 300% on the year before. So a couple of interesting things happened. We're based in Singapore. We've never actually raised money from the VC, so all our previous fundraising has been friends and family and a company in Japan. So it was very interesting. In about March, April, we got a lot of inbound leads from London, investors in London, VCs in London, and inbound New York, and actually inbound from a $5 or $6 billion family office in LA. I had one meeting with the LA team, and they actually sent me a term sheet the next day, which was pretty astonishing. A convertible bond that will close when we raise the rest of the money, and a lot of interest from PE companies at London and VCs, mainly based around Oxford, Cambridge, the cluster, because I guess with deep tech. Conversely, kind of interest in Singapore. From VCs in Singapore, but incredible interest outside of Singapore. And what's interesting about the COVID-19 issue is that we've done all of this on Zoom, and if there wasn't COVID happening, there's no way that these PEs and VCs from kind of Oxford, Cambridge, and London would talk to us, and there's no way that the guys from New York or even LA would probably even talk to us. Never mind talk to us, but allow us to pitch, then actually send term sheets. And there's 2 or 3 investors kind of rummaging around our data room at the moment from the UK. So it's been fascinating, and the fact is that we've done everything virtually. We actually haven't had a face-to-face meeting with the VCs or the PEs that we are talking to. We did pitch to a couple of guys in Singapore, actually also over Zoom, which was kind of interesting. But I think it's been remarkable in the resilience of, number one, our customers, and we were very lucky that we were primarily focused in pharma and in US government intelligence. We do a little work around brands, but I mean, essentially those clients came back and doubled on down, and it's quite resilient how a lot of the PEs and VCs we're talking to are actually incredibly open and receptive to actually making decisions over Zoom. So I've been unbelievably pleasantly surprised at how forthcoming, open, and kind of, understanding VCs and PEs are, because you've put this seminar very well together, but, when you're doing a Zoom to somebody in California or New York, I mean, there's 85,000 things that go wrong, and they're pretty patient when the Zoom drops or the slides don't share properly or your voice drops out. So it's been a pretty, a very pleasant experience.
Yeah, I mean, it's definitely leveled the playing field a bit more, hasn't it? And
I think it gives more opportunity. I was doing a presentation at the AI conference this morning. Kind of the Sotmandu was there and the MAS guys were there, and we were having this debate about, we've hired 50 people in Manila since March, AI engineers, and people are saying, well, what about Singapore? And were you thinking of actually basing people? And kind of the point I raised to them is actually it doesn't really matter where you live anymore. I mean, you could be a global organization out of Singapore like us, and 95% of our business is actually outside of Singapore. 40, 50 countries, 67 countries actually we're doing business in this year. Or you could be a global company out of London and you don't need to have a base in Singapore. You can go directly to the markets. Yeah. Some very interesting structural challenges that governments and organizations are going to be facing about, do you need regional offices anymore?
Yeah, it really doesn't matter anymore. And actually, C-suite is living that too, right? Because we're a team of 6, 3 of us are in Singapore. Our head of UX, he's over in Budapest in Hungary. Our CTO and co-founder Alan, he's over in Jakarta, Indonesia. So yeah, it's definitely a new world. Okay, all right, good stuff. I want to keep things rolling. I see we have some brave founders now who are stepping up to the plate and offering to do an elevator pitch. And by the way, to everyone else on the panel, we'll come back to this topic if you want to afterwards. I just want to give the guys on the other end a chance here. So if, Christel, we can allow Luke Tai to come on screen and give his 60-second elevator pitch. And let's be disciplined and keep it to 60 seconds. And then we'll vote afterwards and we'll ask the panel for their thoughts if they have any. Luke, are you there? I think you will have to enable your camera and microphone to join us.
Yep.
Hey guys, can you hear me?
We can indeed.
Okay, cool. Well, thanks for that. I wasn't really expecting to do this. I'm not completely a founder. I joined a core team of a small startup very recently. So I'm just going to try and address a couple of things. Very briefly, the startup is called Bill Indonesia. We're looking at bringing financial inclusion to, somebody earlier mentioned market size, to the 175 million unbanked Indonesians who basically work only with cash. Now, as you know, COVID has done an enormous hit on trying to go cashless for a lot of people. It's brought things to the forefront. I heard the idea, the term called time earlier. Is the timing right now? It has actually jump-started this for us, because instead of looking towards the end of 2021 to start implementation, we had to start already. We've been bootstrapping in general until now. And to answer somebody else's question, yes, we are looking for money. We're looking to start with $1 million US. We currently have already 30,000 users. We've already got 800 POSs involved. We have a contract in hand that is exclusive for one of the largest public transportation companies in Jakarta itself. That is an exclusive contract. And basically, it's looking at how fast can we implement, how fast can we grow, how fast can we make money. That contract is, very simply spoken, we implement for the first year without fees. The fees hit in year number 2, 2022. That is when obviously the cash flow is going to be polite, explode. And solving a big problem was mentioned, and timing. So timing, I've answered it. Solving a big problem is honestly all the small bits of money. So there's an enormous demand for this, and it's going to be what we call product-led growth. Because if they implement it like in Singapore, the Easy Link cards, where they don't wish to take cash.
Luke, we'll have to call it there, I'm afraid, buddy, because you've had nearly 2 minutes rather than 1.
Sorry about that.
Great pitch. Sounds really interesting. Unbanked Indonesians, 30,000 users, $1 million already. Let's ask the audience what they would think. So if we could bring up the poll question to allow people to vote on whether they would invest in this company now. And the options are, for those watching on catch up who can't see the poll on screen: yes, no, not sure, maybe in the future. So get voting. We'll give you 30 seconds from now. Would you invest in Bill? And panel members, you can vote too if you're that way inclined. Oh, okay, maybe not. Okay, last 2 seconds. All right, Christel, I think we can call it there and bring up the results. Okay, so a mixed bag there. Luke, 24% say yes, which is good. 28% say no. 41% not sure, and I think that's down to the fact that you only had 1 minute, although you stretched it to 2 for your elevator pitch, and 7% say maybe in the future. Okay, interesting. So I'd like to just open it up to the panel there and ask if anyone was interested, if anyone liked what they heard, or if anyone has any thoughts at all about Luke's company, Bill.
You know, I just want to jump in real quick and tell Luke, hey, don't be disheartened. Like, just because 60-something% people either said no or don't, you know, don't read into that. One of my portfolio companies spoke to over 100 VCs, all said no, and then Sequoia finally just randomly called them and said, hey, we'd like to invest. So, you know, who knows what the market's saying?
Thanks, man.
Yeah,
I mean, resilience is an underrated trait.
You only need one yes. 99.9% of the time people say no, so one person. Actually, that was good. You got 24% yes. That's actually pretty cool for 2 minutes.
Agreed. Okay.
It's a hard thing to do.
All right. So Neil, I think it's Neil Charter, has got a company called Nevo. So Neil, if you could prepare yourself. And before we jump to Neil, does anyone else on the panel want to jump in at all to talk about Luke's company, Bill? No? Okay. All right, Christel, I think we can allow Neil to join us now if he's ready. And Neil, if you can enable your camera and mic.
Yep, it's coming in a minute. Okay. All right.
And please do try and keep it to 60 seconds because we've got a lot of ground to cover tonight. So pretend you are stuck in an elevator with a VC or an angel or some sort of whale.
I've got big shoes to fill there, Luke. All right, well, let's have a go. I run a co-living operations company based in London. We essentially are an operations company for landlords or mom-and-pop landlords that run house shares. So we know that renters and landlords are super price sensitive, especially in London. And we know that room finding platforms have really proven that there's a demand for affordable rooms. And they're largely being serviced by these mom-and-pop small landlords. What we're doing is kind of linking these house shares together. So we know that landlords don't like paying massive share fees on their properties. I'm sure a lot of the panel own their own buy-to-lets or property assets across the world. But you know, in my experience, people don't want to pay as little fees as possible. So what we've done is try to find or give landlords a tech-enabled service, which is at a fraction of the cost of an agency. So for renters, we give them a brand that they can trust. We provide a 24-hour help desk. We give them discounts at local amenities. We hold events in their local areas, and we link them together. So we're trying to avoid that kind of isolation that they kind of feel in these house shares. And for landlords, we find quality tenants fast. We reduce voids. We manage their property using cutting-edge tech like boiler monitoring. We're taking the headache out of everyday management situations. So we're trying to combine these two areas or two problems that we solve.
Last 10 seconds, Neil.
Okay.
Yeah. Final 10 seconds if you want to get one more sentence in.
Well, that's it, really. It's in a nutshell. We're a co-living operations company based in London.
Awesome. Okay, great stuff. Thank you for that pitch very much. So let's move straight to the audience vote then. Let's ask, would you invest in this company now? The options are yes, no, not sure, maybe in the future. Get voting. You have 30 seconds. Okay. All right, just another 5 seconds, I'd say, Christel. Okay, let's call it there and bring up the results on the screen, please.
Oh, no.
Okay.
20%.
Yes, say 20%, Neil. 37% say no, 37% not sure, and 6% maybe in the future. Okay, interesting. So similar type of results, but I think, again, as Ian was alluding to earlier, anything in double digits in the yes column is probably a really good result. So well done. So let's ask the panel, what do you think of Neil's co-living company? Nevo it's called, Neil, right?
Correct, yeah, Nevo.
Anyone on the panel want to jump in here before we move on to the next topic?
I think that 20% voting for a co-living company during COVID is a spectacular result. It must be a particularly challenging year for you in operations, I suspect, is it not?
Well, the thing is, I run my own portfolio of co-living properties across West London. You know, I've actually found very few voids. I've provided great service. Work from home is, you know, I've increased internet speeds, and tenants typically have been happy. So yeah, we're quite lucky. The challenge that a lot of co-living companies face is the purpose-built sector, where planning permissions kind of failed. But the house shares that pre-exist and are already there, they've been occupied pretty steadily over the period.
Got it. Okay.
I think it's hugely interesting. I was in a meeting yesterday with a bunch of PEs out of London, and they brought in a company not too dissimilar, but remote monitoring for Airbnbs. So, you know, Airbnb goes public. You know, it's the whole ethos around Airbnb. It's clearly going to be massive. They have more rooms than every hotel chain put together. So these kind of things that are coming out, you know, these service layers that are going to be added on over and above Airbnb, remote monitoring, the company I met yesterday, and Neil's company. I think it's you know, these companies have legs.
That's good to hear. Yeah. Boiler monitoring specifically is the nightmare of any landlord. As soon as you get a hot water or a heating complaint, gosh, you know, you're under a time limit to go and get it solved. So being able to use machine learning and algorithms to predict boiler failures is worth its weight in gold to a landlord, because you can, you know, avoid call-out fees and all sorts of stuff. But that's just one solution in a whole suite of solutions that we offer to landlords to help them manage their properties more effectively.
Okay, great. Well, listen, to everyone on the panel, if you'd like to connect up with Neil or Luke afterwards, just let me know, and then we'll make the connection so you can carry on the conversation if you're so minded to.
Thanks,
Cool.
Dean. Really appreciate you.
Pleasure.
Thanks.
Good to see you, Neil. Thanks so much. All right. So far we've talked an awful lot about the past year. And the present, I guess, but not so much about the future. A little bit maybe earlier on, but what does the future hold with regards to the investment landscape? Therefore, I guess the big question for the panel is, how frothy are the financial markets, and should we expect another crash? If not, what does a recovery in 2021 look like? Is it U-shaped, K-shaped, chair-shaped, or, you know, I heard someone talk about inverted square root-shaped recently, or is it something else entirely? So Parminder Singh, Parry Singh, as well as being an angel investor, you're the Mediacorp Chief Commercial Officer. So I guess you're pretty dialed in to things in this area. What do the markets and the global economy hold for us in 2021, and how will it affect the startup scene, do you think, Parry?
So Dean, I don't know the shape that the recovery will. Well, it could be W, V, U. I don't know. All maybe it won't look like any of the characters of the alphabet. Maybe it'll be totally different. But here are the things that we are hearing from our clients now. Firstly, the last 3 to 4 months have been pretty interesting because most of the companies have made peace with the fact that things are what they are, and you need to get on with things. And that's really and that's an important sign, right? Because if you look at, this whole thing started in February, and for the first 2 to 3 months, everyone was in a state of shock. People didn't know what to make of what's happening around them. Then the next couple of months were about, all right, trying to come to grips with the new reality. But the last 2 to 3 months, we've seen companies saying, all right, there's no immediate answer. Even if we have a vaccine, it takes a long time for people to be vaccinated. And by the time the people get vaccinated, it's going to be a year or so. So let's make do with what we have. So that's a good sign. And now these are big established companies. But I think one more thing that's happening is that people are realizing that the future will be a little different from the past, definitely. And that's a great space, and that's a great opportunity for startups. What are startups? Startups are eventually problem solvers. Problems get maximized when the future looks different from the past. And we see a lot of movement in the startup space, new ideas, new problems being solved. And two of the things that we are very excited about is, people are realizing that synchronous learning and synchronous earning, are things of the past. The way we will learn in the future, the way we will earn in the future will be different. No longer do we have to go to the office at the same time and be in the office from 9 to 5. No longer do we have to be in the classroom at the same time and be together. And we think there'll be a lot of solutions that will help people learn and earn asynchronously. And that's an amazing opportunity for startups, for companies to be in. And what we are seeing now, the fact that we are all on Zoom and having this discussion is great, but we think that's just the tip of the iceberg. Systems like this, solutions like this will evolve, and that will give space to a whole new, not just category of startups, but established businesses will find a completely different way of, learning and earning. So we think it's good. Things are getting back to normal, and we see our clients are very optimistic. We work with a lot of e-commerce companies who are seeing better revenue than they did last year. So, things are getting back to normal, and hopefully next year we'll see growth.
Okay, loving the optimism. A view from a startup founder would be nice here too, actually.
Yeah, I'm happy to jump in. I mean, there's two things that I find very interesting is that we do a lot of work in the pharma space, and we just won a contract this week, believe it or not, for COVID-19, the vaccination, the marketing of that, because anything up to 30 million people in the US do not want this. There's a lot of fake news around vaccinations. So we see a tremendous amount of money being spent in the marketing of COVID-19. And to echo Parminder, I mean, our JV partner in Japan, Rakuten, who's very large e-commerce company, about 110 million customers, that their business has rebounded back incredibly quickly, and we're very fortunate to be kind of doing most of their digital marketing for them. So e-commerce bouncing back fast, and pharma bouncing back fast. And then as soon as Biden was announced as the winner, maybe he's going to be the winner, who knows what's going to happen, but there was certainly in the government world, we saw a large influx of contracts coming in because people realized that with Biden coming in, there's going to be a huge stimulus. And then secondly, interest rates at zero. How can the markets not go up?
Yeah.
To put your money, well, apart from, being VCs like here, but at long-term interest rates at zero, it's got to be the markets.
Yeah, it does feel like things could have been very different if the US election had gone another way, right? Okay, yeah. I wanted to ask the Arto founder, Belinda Ang, what you think here, Belinda, if you're there.
Hi, yeah, I'm still here, yes. I think it really depends on the industries involved. Obviously, if you're going to talk about hospitality or tourism industries, and travel related, it will take a bit of time to bounce back. And also because in the case of Singapore, there's a lot of cushioning and support from our government here. So by the end of 2020, a lot of these budgets will be used up. So a lot of businesses will be on their own. So therefore, I think in the initial stages, there will be a wave of retrenchment again. That is my expectations. And then before the market actually takes time to recover and bounce back. Obviously, in my point of view, there are a lot of other industries and businesses that actually see an improved situation. Like even for me, although we're not launched yet, and we have not officially opened around this year, but in my experience, trying to go to the market, talking to people and trying to get investors' interest, just sounding them out, I think it has been actually relatively a lot easier than previously. So this year when we go out and talk to our stakeholders, including art organizations, artists, etc., it has been a lot easier because they now feel like consumption of art and the way it's being presented has to change. So they're a lot more open to conversations than in the past. And there's less skepticism involved. They are more open to risk. That's one. Secondly, I have had the opportunity to speak with a lot more people in the VC world during the pandemic season. And that means across the board, as in globally. Previously, I don't believe I would have the opportunity to be connected with them, but because of the influx of a lot of global events on Zoom like this, so you can actually get connected to more people easily. And we have also been able to build a much more global team because of, we removed the need to be based out of Singapore. And so I think that there are a lot of good things that are coming out of it, but it really depends on the industries that you're involved.
Got it. Okay. And Andrew Stott, you're an investor and consultant, and we've discussed this topic briefly previously. And I think your call is that we are in for a lot of economic pain ahead. I mean, when we spoke, it was before the US election result. Andrew, do you stick to that stance, or do you see some room?
Yeah, I'm usually the most positive person in the room. So I get invited to dinner parties all the time to make people feel better about their own outlook. I do. I mean, I think actually what COVID has done is in some ways paper over the macroeconomic cracks that were already there. Italian risk of default, Brexit, European, pan-European economic stress. US was going into recession, other than in jobs market and frothy cap markets. So I don't think any of that has changed. The fundamentals are still there. And what we will see in a localized sense, you can pick a single company, it'll be very successful. You can pick a vertical, they will recover faster or quicker. And some in which, are doing better than they'd ever done. But overall, I think we're heading into a period of severe, prolonged economic turbulence that is being masked by frothy markets, low interest rates. There's nowhere for governments to go, really. So, again, the US election, I think, is what it is, but actually there's far greater macro trends at play. And so what I'm interested in as an advisor to companies, as a multiple founder, recently a fintech in COVID times, is what do you stop talking to me about COVID, start talking to me about why you've got a resilient business model that looks at 3 years and why you're raising enough money to see you through a prolonged period of economic pain. I could go on for hours or not, but fundamentally, I do see the next few years as being very unstable and not helped in some ways by a slight masking of the underlying wounds through COVID, through Brexit, through, on the plus side, massively positive public markets and lots of private equity, SPAC activity, generating exits for, various companies. So I think that's the holistic view. It's always possible to see sunshine through the clouds in limited areas, and that's very much what I'm focused on in the companies I'm involved with.
Yeah, that's a good point. So founders, you need a 3-year plan, if not a 5-year plan, to come out the other side of this. Okay, let's ask. Thank you, Andrew. Let's ask Mutia Adriana, who's STEB Asia co-founder and CEO. you're building a business during a downturn. I think you're only a few months old now, but they do say, you know, the best businesses get built during a downturn. So Mutia, how confident are you about next year? Are you with us? I know Mutia had some problems tuning in earlier. Okay, all right. Well, Mutia, shout if you come live. But let's finish up this topic then with the thoughts from Daniel Walker, who's the Ziegel founder. Daniel, do you see opportunity or crisis management ahead?
Well, we've heard from Andrew, so I'll say opportunity on the basis that two miserable middle-aged white men talking about how depressing the world is would probably end the day, wouldn't it? No, we watched with despair at the start of the year as lots of our clients went bust. You know, we are exponentially exposed to the SME and startup markets because a lot of our clients are smaller businesses. And ordinarily we'd see around about 5% of market churn. So that's to say that every year, 5% of our clients will stop paying us simply because they go out of business. And obviously that number was substantially higher at the start of this year. Delighted to say that actually it's pretty much back to business as usual right now. I think the concern I have locally, and by locally I think I mean sort of Southeast Asia in particular, is that there's so much reliance in the small business sector where we focus on government support, particularly grants, particularly you know, ways and means of staying afloat which don't logically make sense using ordinary metrics of business. I think once those handouts start to disappear, which of course they will do, particularly in Singapore after the election, and I think more generally anyway in the region, next year is going to be painful simply because of that, because there's a lot of companies that are still propped up. And we see it because, you know, we see and talk to lots of small businesses. So I think it's going to be quite painful. Globally, I have no idea. I have to just hope that, there's enough good news to outweigh the bad news. And clearly, Britain is charging ahead with a vaccine which will save us all. So let's see how that pans out. But yeah, I think that there is a huge disconnect between what the stock market says and what Joe Public SME is experiencing, and I think that ordinarily should be a flag in its own right. Yeah,
a good counterbalance there. Some optimism and some negativity, but that's what
more negativity, unfortunately. Sorry, as I talked myself out of it.
Okay, well, why don't we ask the audience now what they think, and after that, we've got a number of founders who've offered to do their elevator pitches, so we'll have 3 coming up. If you want to prepare yourselves, the founders of Bettercast, Educate, and ACAD Asia. Okay, all right, so just get ready. But before we jump to the founders and their pitches, let's do the audience poll question. So what do you expect from the global economy in 2021 is the question. And the options are recovery, stagnation, depression, collapse for the extremists out there. So get voting. We'll allow you 30 seconds from now. And let's see what the collective thoughts are. Okay, another 10 seconds. If you haven't voted yet, please do now. All right, I think we can call it there, Christel, and bring up the results. Okay, so the audience is erring on the side of optimism. 51% say recovery is coming next year. 29% say stagnation. 18% say depression, and only 2% say collapse. Well, thank goodness for that. Okay. All right. Interesting results. Great. Thank you for participating there. So now we can call up the founder of Bettercast, and Christel, if you're able to allow him to activate his camera and mic, and then you can do your elevator pitch. Please do try and keep it to 60 seconds so that we can squeeze everyone in.
Okay, he should be on his way.
Okay. And what was the name, Christel, of this?
Benjamin, I believe.
Benjamin. Okay, Benjamin. Benjamin Powell. Okay. Let us know if there are problems, and we can always come back to Benjamin later.
Yep, I think it's reconnecting. Maybe we could just try another startup first, and we'll come back to Benjamin.
Okay, let's do that. Absolutely. So let's go to the founder of Educate.
Benjamin just came in. Would you like?
Okay, Benjamin, you're up then.
All right.
Hi everyone, I got kicked out rather than.
Sorry about that.
That's all right, that's right. Also, this is the very first pitch I've ever done for this product, so.
Wow, into the detail.
Okay, so Bettercast is a virtual conference and content monetization platform. As you are all very well aware, COVID's decimated the events, the 170 billion plus events industry. So I'm trying to capitalize, as I think it was Andrew was saying, capitalize on this issues rather over the next 3 years. So the market's currently dominated by really two major styles. It's either the large corporate stuff, which is $30,000 to $50,000 an event out of the ability for small business to access, or they are self-service Zoom. Everyone is getting very, very tired of Zoom. So I'm sitting in the middle, working with the large corporate events at a small budget. And I worked specifically with the AV partners. So I built this product from wireframes to a paying client in 88 days. And that was 2 weeks ago I launched with a paying client with the state government of Victoria. And I have been doing demos with companies like GitLab, with Four Seasons. I've been pulling in an AV partner nearly daily, building up this thing. And I'm currently in angel investment mode, just trying to get a position where I can capitalize, because right now everyone is frantic to save their industry of events. So that's what I'm trying to do.
All right, brilliant. Thank you, Benjamin. Appreciate that. Okay, so let's ask the audience what they think of Bettercast, the virtual conferencing company. So the poll question is, would you invest in this company now? Yes, no, not sure, maybe in the future. Please get voting. You have 30 seconds. Okay. All right, another 10 seconds to go. Make sure everybody votes. All right, let's call it there, please, Christel, and bring up the results on the screen. Okay, would you invest in this company now? 21% say yes, 36% say no, 33% not sure, and 10% maybe in the future. Okay. Okay, so again, a good result, above 20% with the yeses. So well done. Panelists, any thoughts there?
Hey, Benjamin, I didn't understand what the product is, and I think it's a limitation of the format, but I can tell you the problem you're solving is real, it's urgent, and it's big. So we'd love to know more.
I'll reach out to you later.
Yeah, so absolutely, panelists, you can tell me if there's anyone you want to speak to from tonight. Anyone that's tuned in, if you've got any questions, any feedback, or you want to ask me if someone else will connect with you, you can do that via email. My email address is dean, D-E-A-N, @csuite .sg, and C-suite has a hyphen. Okay. All right. So,
Dean, I just wanted to jump into Ben's.
Yeah, please do, Jag. Yeah.
Right. So the question was, why should we invest now? And now as a kind of operative word there, right? Like for a lot of investors, you've got to give us a reason to invest right now, not next week or next month, right? So with your pitch, it's the sort of thing that I'd go, well, come back to me in a couple of months, right? Like I'd sort of give you some meaningful task and then sort of send you away and then come back to me. The question you've always, as any entrepreneur has to answer is, why invest now and not 2 weeks from now, 2 months from now? So just bear that in mind next time.
Good advice. Thank you. I'll take that on board.
Good point. Yeah. Any other feedback from the panel, particularly the investors? Yeah.
You know, Dean, there's a, you know, my just advice to startups here is that, you know, there's a system one thinking and system two thinking, right? It's given by Daniel Kahneman is in his book called Thinking Fast and Slow. So for those who don't know, system one thinking is intuitive. If I ask you 2 + 2, you know it's 4. But if I ask you square root of 212 plus square root of 566, you will have to think it's deliberate. So in a stage, in a situation like this, I think you need to appeal to the system one thinking, because you cannot go into the details of what your product is. You don't have your worksheets and so on. So it's good for all startup founders to understand there's a system one and system two thinking, and appeal to everyone system one in a format like this.
Good point. Good point.
I just want to add on a bit, because I've been in the events industry for about 8 years previously. So after listening to the pitch, I still have no idea what the product is about. And I think that was a big problem. I mean, he mentioned a bit about bringing on AV partners, and then he said he was right in between the $50,000 systems and Zoom. So what exactly does he do? So I was in a bit of a question whether is it a marketplace? That's why he needs to bring on AV partners, but it's called Better Cast. So he talks about casting. So I was a bit confused by that.
Yeah, I must admit, Belinda, I'm with you there. I was struggling to find the point.
Yeah, and from what I was hearing, it seems that the product doesn't do anything better or less. It's just priced right in the middle, and I voted a no because of that.
Yeah, price can be a great differentiator, though, right? Some of the biggest companies in the world are built on price difference. But anyway. Unless we have any other panel members who want to jump in here, we've got a couple of EdTech company founders that want to pitch next. Obviously, a very, very hot space for the investment community at the moment. So if nobody else wants to jump in, I think we'll move on to the pitch from Educate. Christel, if you can enable the founder to come on screen there.
Yep, I've enabled on OB.
Thank you.
All right, it's connected.
Okay. Hi, my name is Sujong Han. I'm the founder of Educate. Educate is a class platform that connects freelance tutors with students across everything from academic, business, hobby, and fitness classes. So the mission for Educate is twofold, in that it aims to reform the education system in the US currently, as there's a huge hoopla and overturn of schools being halted right now, as well as to let people have fun and take fun classes, anything from sewing to cooking to baking, and pursue their hobbies and to learn more things and to take more classes. Okay. So one thing that the tutoring industry alone in the US was a $47 billion industry in 2019, and it is only ever expanding. Educate takes a medium role in between abolishing all learning degrees and then doing homeschooling. So it meets halfway and allows people to have connections with their tutors.
Okay, last 10 seconds as we're already. One final sentence? Yeah.
Educate has a great interface, lets people connect with tutors and with their communities. It has great operability, and it wants to provide a comprehensive class service for for people to learn more and to make learning more fun for everyone.
All right, making learning more fun can never be a bad thing. Thank you for that interesting pitch. So let's now move on quickly to the audience vote here. Would you invest in Educate now? Yes, no, not sure, maybe in the future. Please do vote now. You have 30 seconds. The clock is ticking, so get voting. Okay, last 5 seconds. All right, I think we'll call it there, Christel. Let's bring up the results. Ah, okay, EdTech is definitely hot. Yes, say 26%, no 26%, 21% not sure, and 28% maybe in the future. So strongest performance of the night, I think, so far for the founders pitching. Okay, is there anyone on the panel who wants to know more, who's intrigued, who's got some questions or sees an opportunity or a gap in the knowledge here?
I love this area. If you think about tier 3, tier 4 cities in China, this insatiable demand, no matter what happens, for education in the US, and being able to equip people at a low cost online, matching tutors to the needs, especially as they're starting to apply, whether it's for boarding schools or universities in the US, is unprecedented. So, you know, Verican have done very well. William Bao Bean's company, Verican, did incredibly well in China. So I see this just, you know, at the right price point with the right kind of go-to-market, could go viral very quickly.
Okay, interesting. Okay. Do we have anyone else on the panel who would like to chip in here?
Hi there, it's Daniel. I'm sure you already know about them, but it's probably worth checking out Snap Ask, which has been around for I think about 5 or 6 years now, but they exploded about 2 years back and raised a bunch of money. They focus on Taiwan and anyway, Northern Asia, so probably worth looking at them.
That's always good when you get tips about your potential competitors. Yeah. Okay. All right. Fantastic. Well, I think we will move on to the next EdTech startup. I think it's ACAD Asia. I may be pronouncing that wrong, so forgive me if I am, and I'm sure you'll correct me soon. The founder who's about to come on and do the elevator pitch. If you could enable the founder of ACAD Asia, Christel.
Yep. Hi, Dean. Hi, this is Nilesh here, and it's ACAD Asia. ACAD as in academics. So it's ACAD Asia. And also good to see quite a few familiar faces here. Hi, Steve. Hi, Jeffrey. Hi, Mohan. I think to get into the pitch, EdTech has been doing great ever since COVID broke out. There's a lot of tools available out there, but the main issue is that the teachers keep going back to teaching on Zoom. And it's not because that the tools are bad. It's primarily because a majority of the teachers, especially in Asia, are not equipped to basically train online. They have never even learned anything online themselves, let alone teach. And this is exactly where we at ACAD Asia come in. So we are a Singapore-based mission-driven EdTech business that empowers educators with professional development courses and tech-agnostic course design tools, kind of like Canva, but for teachers. We help upskill teachers at a mass scale and have recently secured contracts in place to train more than 300,000 teachers in the Philippines over the next 1 year. And our vision is to be the single largest online community for teachers across the region. That's my pitch.
Fantastic. Well done for keeping to time. Okay. Canva for teachers. Panelists, anyone got a view here? And then we'll go to the public vote after that. Okay, maybe we'll give you some time to think and do the public vote first in that case. All right, so would you invest in this company now? Yes, no, not sure, maybe in the future. Please do get voting. You have 30 seconds. Okay. Okay. Last 10 seconds or so. Okay, I think we'll call it there, Christel. Wow, okay. 51% say yes here. They would invest in ACAD Asia, sorry. Only 16% say no, 26% not sure. Maybe in the future, 7% of people. Well, the people have spoken, overwhelming. I'm sure the panelists must have a view here in that case. Anyone want to jump in from the panel?
Nilesh, obviously you've got a lot of good friends in the audience. You paid them to come along?
Well, no.
No, it's good to see you. It was a good pitch. I like the fact you had your shameless self-promotion of the background in there as well. I like the fact that you kind of explained what the pain was, and I guess, you know, first of all, credit to all of the founders for actually presenting, because it takes real guts to do this in this kind of audience. But I think, Nilesh, what you did, I think, was to paint a little bit around the pain point, and then also you put a hook, which is Canva for teachers or educators, and that's kind of memorable, and I like that. So well done.
Thank you.
What's the consensus on the panel about adding that kind of hook where you are referencing another company in your descriptor? It seems some investors like it, some don't. I guess the ones who do like it because it saves time. Any thoughts from the panel? Jeffrey, Andres, Joanne?
Yeah, I think maybe I'll just jump in and comment a little bit on this, as well as you know, both of the startups that's just presented. I think generally when you're pitching to an investor, because you usually come from a place of knowledge and niche, and you know, you can't expect us to know, you know, the education space or the fintech space the same way that you do. Using these commonly known businesses create that baseline level of understanding. So I think it works very well if it's an elevator pitch. You know, immediately gets us to the same level of thought that you want us to be. And as for the two companies that just presented, I think they're both very interesting. And for companies that I've seen, you know, in this similar space with this similar setup, it's usually very easy to excite the angel and the investor on the other side of the table. It is usually the unit economics and the financials that fail the test, because, you know, when you start digging down to the details, like, you know, what's your defensibility, what's your cost per user acquisition, you know, how well you know your the canonical units. That's where most founders, I feel, are not exactly aware of themselves, especially at an early stage.
Yeah. Okay. Mohan, any thoughts on this? Have you covered ACAD Asia on E27 already?
Yeah, I actually used to work or consult for an edutech company many years ago. This was way back in 2012. And I mean, the problem that Nilesh is talking about, right, has been prevalent in the education sector for a very long time, right? You know, we were working primarily with educators in the preschool and, you know, early education stage. And they still serve their market and are doing really well, right? So I think the education sector is something I personally like. I think the edutech startups have also realized during COVID where their products lack, and I think there's a massive opportunity there. So yeah, I'm excited by what ACAD Asia is actually doing.
Okay. All right. Would anyone else on the panel like to pass comment here? No? Okay. In that case, I think we'll move on. We don't have long left, so if you are wanting to do an elevator pitch, now is your golden opportunity to do so before this star-studded cast that we have on the call tonight, who are probably getting tired by this time, given we're past 9 p.m. So please drop your one-sentence descriptor in the chat box there. and if it's super interesting, we'll call you out and you can do your thing. So while we're allowing you to do that, I want to ask a question actually to the whole panel, but perhaps to start with Anastasia, because she's been through this journey. Accelerators, are they worthwhile for founders and for startups? Or, you know, can the time of a founder or a founding team be better spent out there in the field, or are they a good, you know, a good preparation for going into the field? Anastasia, why don't you tell us about your experience first, if you're able to?
Yeah, absolutely. So I'm a first-time founder. I joined the Antler program in July of this year. And the first 3 months are essentially spent as a little bit of a startup school. So you meet other potential co-founders, you brainstorm and validate ideas, and you pitch for pre-seed investment at the end of that initial 3 months. I've spoken to a number of people who are thinking about applying to this type of program since I left Antler. And I think, again, it really depends on where you are in your founder journey, what type of business you're looking to start up, and really what you're looking to gain. So I would say, as a first-time founder for me, the initial 3 months was incredibly valuable in terms of connecting with other like-minded future founders, really just learning the essential 101s of how to pitch and how to speak to investors, how to validate an idea, incredibly valuable. I would say if you've already been through the process, you know, yourself as a founder of a VC-backed company, I wouldn't say that type of accelerator would be necessary. Again, depending on exactly what you're looking for. And then in terms of the kind of investment that you get from something like that, again, it's just worth considering what you're really looking to achieve from this. So from if you're looking to kind of get into the VC world, it's a great introduction. You'll meet not just the investors from your own accelerator, but they're great for introductions into the world generally. But if you're looking at, you know, starting a business which isn't necessarily VC backed, you're looking to meet angels, then it's perhaps worth considering whether it is the exact right approach for you.
Got it. Okay, that's really helpful to hear that, and I'm sure that people out there listening will you know, find great value in that. Why don't we ask Jeffrey? What's your view on accelerators? Is Jeffrey still there?
Accelerators. I think it's helpful for first timers, but it's not. I think not everyone fits it. So I would say, you know, some people can get by with, you know, a cohort of friends who are founders. Some people get by just by pushing product and just doing business and not thinking so much. But there is a fit for a certain type of founders. You know, so I would say accelerators, go ahead, do what you're supposed to do. There are definite ways to make accelerators better. I think it's difficult to be a very good one that makes money. Hence the founders also need to be careful when you search and apply for which one. So yeah, so do ask around, get some feedback. Yeah.
Do your homework. Okay, Fei, and
just to what Jeffrey said, I think you know, accelerators definitely have their role to play. I think with a founder, either early stage, as Anastasia said, or if you are a founder and you are thinking about, well, I need a co-founder, and I'm also looking for a problem to solve, then you know, accelerators like Antler can do a great job. And I've personally invested in 2 sustainability startups that have come out of Antler, and you know, very, very smart founders who weren't together, were you know, kind of found each other through Antler, and I personally invested in some of those. But there are also a whole bunch of accelerators which focus maybe a little bit later scale, like Betatron in Hong Kong, kind of a little bit later stage, I think a little bit more at professionalization and scaling of a company. And there are also accelerators who focus on specific areas like, you know, energy or shipping or blockchain, for example. So I think it really depends. So with investor hat on, highly valuable because it's highly curated deal flow qualification process that they've gone through already, particularly if they've gone through the sort of the demo day successfully. And then I think from a founder, I think they have a role to play. But as Jeffrey said, I think do a bit of DD on the specific program.
If I could jump in, because we've been on a, not really accelerators, but kind of maybe corporate accelerators. So we did one with MAS where, you know, Sapandu and a couple of guys kind of adopted us and really kind of pushed us pretty hard and introduced us into the FinTech Festival and made all that easy. And we actually were one of the winners of the FinTech Festival based on that accelerator, and that kind of exploded our business. And then we with KPMG, the Digital Village, they put us in front of OCBC, and we went on an 8-week program with OCBC. And for them, it was more painful than it was for us because, you know, it's sometimes it's hard, but basically, you know, we now have a very large slice of business in OCBC, which has been running for 4 years now, primarily because we did an 8-week sprint with them, sponsored by Digital Village. And then we got into a Mercedes accelerator, and we've been running 80% of Mercedes marketing in South Africa. We've been picking up business in India, Korea, Japan most recently. So for us, and also we got onto the plug and play accelerator in Japan, and that allowed us to basically pivot into Japan by them giving us an office, and we hired a bunch of guys and, you know, kind of give us a bit of a landing pad, right? Because, you know, Tokyo's a tough place unless you really know it. So I'll put my hands up and say that, you know, KPMG, Digital Village, MAS, all these corporate company accelerators were absolutely phenomenal for us. And it, you know, the market fit and the pivot's hugely important because in 8 weeks, you get a bunch of very smart people that tell you honestly because there's no ulterior motive. And if you listen, which we like to think we did, and take the criticism, right, on the chin, it made us, I would say, 100% better.
Understood. Okay. Christel Quek, do you have a view on this?
No, I think that's a really good point. I mean, we didn't actually go through an accelerator, but what we did do is to work really closely with a strategic partner, a Chinese TV manufacturer called Hisense, and they own the Sharp, Toshiba brands, and they have, you know, amazing presence in South Africa as well. You know, going back to Ian's point, incredible market with great opportunity there. So, I mean, I think accelerators are really good for, you know, I mean, first and foremost, great revenue line if, you know, everything is more or less aligned. And, you know, entrepreneurship is really, you know, my founder and I discussed this quite a lot, you know, it is a really lonely journey, you know, and you need a lot of stamina, you need to have the grit, you need to have the adaptability, you know, to sort of see yourself through and not be discouraged and yet keep climbing up that hill, you know, or look at, you know, when you should descend from the hill in order to climb up a new mountain, right? So I think that's something that we have to be critically aware about. Actually, thank you, Steve. You have just reminded me. I need to jump onto my call.
Please do.
Got an investor call.
Yeah, I do have one. I need to go by like 9:15, 9:50. So I need to jump off now.
If you need to go, Christel, feel free to. Thanks so much for your
Okay, thank you so much, everyone.
Awesome.
Thank you. Thanks, Steve, for being my alarm clock.
No worries.
Okay. So what about Fei Yao? Are you there still? Did you go through an accelerator with NewCampus?
Hi. Yeah, we did. I resonate with a lot of the other thoughts already shared. I think it serves a certain purpose for a certain kind of founder. I do think that, you know, agnostic accelerators are useful for first-time founders. When I first went through one, I was a first-time founder. I was a lot earlier in my career, so it was really good to plug me into a network of people that I just previously was not available in my community. But what I have also found useful the past couple of years is more partnership accelerators. So, you know, if they can open up a revenue stream, if they have an unfair distribution channel, that has been something that has been very useful for us. So, for example, you know, we went through an accelerator with Mercer. No equity, but what it actually helped us do was that we're now a co-sell partner with them, so that they actually create a new product line where they sell NewCampus to their clients as well. So that's been something that has been very beneficial for us.
Got it. Okay, good to know. So I think we've got time for a couple more questions, and if anyone is wanting to pitch, time is running out, the clock is ticking, so please drop your descriptor in the chat box there now. But I wanted to go with a fun populist question, if I may, for the panel. Are shows like Shark Tank helpful for both founders and investors looking to find their own way and pick up tips, or are they not at all representative of the process? So I think if we start with perhaps Daniel Walker on that one.
Goodness me. I'm fortunate to have not had to deal with angel investors for quite a long time, but I'm sure there's plenty of angel investors that walk around thinking they're on the Shark Tank. I'm sure there's probably a hideous world for lots of startups out there with the people they have to meet. Fortunately, most people you come across are very professional and don't resemble any of the characteristics of people on TV shows, but I do hear about horror shows, more in Hong Kong actually than in Singapore. So I'll leave it at that.
But do you watch it, Daniel? And if you do, who is your favorite shark?
I used to watch the British version, not the American version. So my wife interviewed Duncan actually a long time ago, Duncan Bannatyne, who famously set up all the gyms across Britain. We Brits favour the British version.
Oh, that's Dragon's Den, isn't it? Rather than Shark Tank. Okay. Andres, the boss, what do you think?
I'll be honest, I don't have much of an opinion on this. I think I watched one or two. I think I watched one that I really enjoyed, was sort of this like a squatty idea, like sort of like a pot where you could sort of squat on. And it was, I think, quite well done. And I mean, I think definitely as a founder, especially first-time founder, but in general as a founder, you need to learn how to sell yourself, and it's probably one of the most critical skills. So learning how to pitch, whether it's for investors or for clients, is obviously a crucial skill. So anything that helps you do that helps. I learned the hard way. I pitched hundreds of investors for my first startup. And at some point you get better at it. I think the show business themselves, can you learn something from it? Maybe. I think there's some creative ideas, but it's a very specific format. I think most investor meetings are really sort of in a Starbucks type of environment, at least before. Now it's more Zoom. So it's a very different format. And I think it really comes down to that format. It goes back to the sort of system 1, system 2 thinking. If you have a serious investor in front of you, you probably are not looking at just putting up a show, but you need to get into the substance of what you're trying to do. If it's an angel investor and a small check, maybe you can get away with some, putting up a song and dance, but you probably need to get into the substance of things, and that's just a different format than watching an Angel Den or something.
Absolutely, yeah. Jag Singh, any thoughts?
Sorry, Dean.
Yes, please do, Andrew. Go ahead.
Sorry, Jag. I just wanted to jump in and say that for me, the big lesson that you could take from Shark Tank, Dragon's Den, etc., is actually, as a business, think about the format designer of that show. They're the winner. They created a business that was effortlessly scalable, relies on other people tuning in, and just generates money in every country in the world. So actually there are business lessons, I think, from Shark Tank, and it's mainly who owns the rights to Shark Tank and how they built a product that is low cost, right? 5 people sitting in a chair interviewing startup founders with a camera. That doesn't cost anything to make. Would work in every country in the world, potentially, where there's entrepreneurs and egos and business people with money, and is eminently scalable by selling the same rights to the format to distribution deals all over the world. So I'm being slightly facetious, of course, But actually, I would look at it and say the real winner here is the person who created that format and is making royalty, annuity, monthly recurring revenue, you know, from a program that is very easy to build.
Fantastic point. Yeah.
As a founder, it gives me severe anxiety to actually even watch that program. Makes me feel nauseous.
So I've had a couple of founders. I've invested in companies that later on went through Dragon's Den. I think the most recent one was the app that allowed men with beards to meet women who like men with beards. Hugely successful. Like all the this was in the UK, so all the dragons loved it. But we actually prepped the founder before he went in, because we basically saw it as it's free advertising, right? And it's not just about that show and when it airs; it's also about the clips. So for B2C companies, like, think about it as, you know, how can you manipulate the producers and actually, you know, the producers, they want to put on a good show. So if you can kind of negotiate things with them in advance, have a chat with them, have a chat with the producers. If you are thinking about getting any of these shows, have a chat with the producers, figure out like what's the best angle for you to deploy whatever messaging you want. And, you know, it's not about the deal with the angel or with the dragons. It's actually getting your message across to, you know, however many consumers are watching that show.
Got it. Yeah, good point. Okay, listen, we're running out of time, but we've got another founder who wants to pitch, who's claiming there is a $700 billion market opportunity. So I'm definitely want to hear that one. So that's Hive HR. If the founder is still on the line there and able to do the pitch, if you could enable their video and mic, Christel, that would be fantastic. And we'll give you 60 seconds to do your thing.
All right, he's on his way.
Excellent, excellent.
Hi, everybody. Can you hear me?
We can. Hi, Damien.
Hi, everyone. Some familiar faces there, so it's good to pitch in front of a semi-friendly audience, at least. So let me talk about my new business, Hive HR. So with COVID, it's fundamentally changed the world of work. We know that almost 400 million people have lost their jobs worldwide, and we all know someone who's gone through it. Underemployed, lost their job, or retrenchment. But we also know a lot of SMEs that actually have gone out of business. And one of the key things is they haven't built a talent marketplace, can't manage their team, or can't afford tools to do that. So we're doing something ridiculously ambitious. We're going after both LinkedIn and Workday to create a hybrid platform we're calling Hive HR. What does that mean? So LinkedIn, we realize the collaboration network aspects really need to work inside an organization, as well as outside. So it needs to go above and below the water on an iceberg. We also realize that Workday and similar tools like SAP are unaffordable for small businesses. They just can't afford $1 million to put something like that in there. And those tools were built 10, 20, 30 years ago. They're legacy systems. So we're putting in place a tool with modules such as work from home, HRIS, well-being, which is built for the 21st century employee.
Last 10 seconds, Damien.
Best thing, it's free. Free for job seekers and free for SMEs. We're a new business, just started in October. We'll do about $300,000 this quarter, mainly off the back of a relationship with Singapore government, and that'll get us our MVP in market in Q1 next year.
Well, that's a brilliant start. So well done you for pulling that off. Okay, let's now ask the audience what they think with the poll question. Would you invest in this company now? Yes, no, not sure, maybe in the future. Please do get voting, and you, as always, have 30 seconds. Okay, halfway there. Okay, I'm impressed by the number of people that are still tuned in at this time and have stayed for the whole thing. So,
must be coffee or caffeine.
Yeah, or wine. Okay, last couple of seconds. Right, let's call it there, Christel, if we may. All right, a great result there. So would you invest in this company now? Yes, say 41%, no 16%, 31% not sure. Maybe in the future, 13%. So a really, really positive result there. Panel members, any comments, questions about Hive HR? No? Did Damien answer every question within?
I've overawed everyone. They're all in stunned silence. It's fantastic.
It seems that way. It seems.
Hey, Damien, I guess just one quick question for you, and good to see you again, by the way. You mentioned that it was free for both sides.
Yep, for small business, yes.
Generating revenue, so I guess that was just a question around business model more than anything else.
Sure, we have a double viral strategy. So every business it takes up has to create an individual employee profile on the Hive network, as well as job seekers coming on and bringing their network in. So there's a double viral to get people into the platform. Small business is defined as less than 25 people, and we're looking for those people to grow. Larger enterprises have to pay $5 per employee per month, but the real focus is how do we build a talent marketplace and sell recruiter access to that? Now, we can't do that immediately, but give it 6 months, 12 months, and so on, as we get companies using the system, getting their employees by default on the network, or job seekers coming through and getting in front of hiring managers. So that double viral strategy gives us the core amount of people on there, and recruiters will pay a handsome sum to get deep data around individual employees.
Okay, good answer. Yeah. Okay. Any other questions or comments from the panel? Okay, well, if not, as always, Damien, you and anyone else out there can reach out to me after this event at dean@csuite.sg. Dean is D-E-A-N, C-suite has a hyphen, and I'll do my best to try and connect you with the people you want to connect with. And the same for the panel. If there's anyone you've seen tonight who really impressed you and you'd like me to connect you up afterwards, happy to do that. Before we wrap up for tonight, there's a really interesting question, unfortunately from anonymous attendee, so we don't know who it is, but it's a great question nevertheless. And Steve has answered it. Steve Melhuish has answered it in the Q&A box, but I'd just like to raise it publicly and ask the panel what they think. So the question is, when we talk about traction, does it have to be actual revenue generated month on month, or the number of users onboarded, even on a free tier initially, or both? So I'd like to open that up to the panel. Perhaps if we could start with Jeffrey, are you still there? Okay.
Yes.
Hi, Jeff. Yeah, so what do you think, Jeff, when we talk about traction, is it purely revenue, or can we talk about number of users, even if that's free users initially?
It depends on what you do. But more importantly, the users are highly engaged, and they're giving you feedback or complaining to you because something's not there or something's missing.
Okay.
I think free users are good, paid users are good, but I think every company have their own North Star metric to look for. I think what you need to do is you have to understand your particular sector and what that metric may look like, and then talk to your investors and shareholders to kind of help you find that metric.
Yeah. So the key is users are good, but users have to be active, right? On a regular basis. Yeah. Okay. Steve, you answered the question. I don't know if everyone's seen your answer, but Steve, perhaps you could you could recount it for us now, if possible.
Yeah, I can read it out, I guess.
Well, talk around it, whatever you choose, my friend.
Yeah, no, I guess for me, around traction is not necessarily around revenue. It's about demonstrating that, I think of things about there's a pain to be solved. There's a solution which is around creating value. So in other words, that kind of plays a little bit to your solution has a market fit and addressing the pain point. And then there's a piece around value capture, which is the monetization. So if you can demonstrate that as a leading indicator, you're actually already starting to create value through engagement, through interaction, through transactions, through cost reduction or generating extra revenue, then logically you should be able to capture some of that value. And generally, you know, if you, let's say you estimate or can work out, which I do recommend doing, that you are generating, let's say, $1 billion of value, then, you know, it would say, you know, roughly you should be able to, you know, capture 10% of that as a monetization. So you should be able to generate $100 million from that, assuming a sort of 10 to 1 ROI. So I look for evidence that if it's earlier stage, is there evidence of that value creation starting to take place before the value capture, in other words, the monetization?
Yeah, so match up your metrics. Okay. Fei Yao, how's it going at NewCampus? Are you focused on revenue, users, both at this stage?
We're focused on revenue. We're a B2B business, so it is number of businesses that we're working with and amount of revenue that we make. Okay.
And how is it going so far? I think you're still quite early on the journey, right?
We are early. It's been a long journey, though. We have worked with almost all players in the education ecosystem. It's a complicated field to navigate. So B2C, B2B, B2B2C, universities, public sector as well. There's a lot of stakeholders involved in education. For us, at the end of the day, you know, what we're looking at now is actually just working with the number of businesses and the number of learners that it impacts at the end of the day.
Okay, interesting. And Gia Wen, are you there? I know you've built a number of startups. How are you placed at the moment? What are you building, and how is the user base or the revenue base looking?
Yeah, I think this differs, you know, from company to company, and it also differs, you know, depending on the round that you're at, you know, be it seed series A or B, you know, it really changes. But I think if I could speak for, you know, maybe even my company, you know, I think at an early stage, it is very easy to manufacture traction. And I think that is where we need to be very, as a company trying to build a product, you need to be very clear what traction is for you. So if you are manufacturing revenue or users, so that it seems that you have traction, so that you can go fundraise, then that will not be the right way to think about traction. I think traction is what gives you clarity of thought around where your company can go, what your product should look like, and like what Steve said, whether or not you have product market fit. And I think this is also the way a company should think about whether they should even fundraise at all, because to get some revenue and some users and convince themselves, an investor, that they have traction when it really isn't traction, is a waste of both the investor and their time. So I think that's all I can say from my experience so far.
Brilliant. That's great value. Thank you there. So we're about to wrap up. So final chance, anyone on the panel who wants to have their say on this topic, please speak up now or forever hold your silence.
Yeah, just a final point, Dean, because, you know, it's a toss-up. See, revenue is revenue. You can't fake revenue, but you can fake users, right? You can buy users using Google SEM and so on. So one thing I like to look at is what's the stickiness that you have? You know, you can have a large number of users, but if they've all bought through expensive SEM, that's of less value than small number of users that are organic and they're coming to you again and again and again. So I think revenue is great, but if you don't have revenue, if you have stickiness, that's good as well.
Got it. A very good point. Yeah. Okay. Belinda, did you have a thought there?
Not much to add on, but I think one thing that was beneficial for me when I was talking to quite a number of investors and mentors was that attraction is in relative to resources and investment. So investors want to see, and correct me if I'm wrong to the investors on the panel, investors want to see, with the limited resources that you claim you have, or the small team or whatever money that you have put in yourself, what kind of traction were you able to get in relative to that? So for example, A company who has, let's say, a $1 million funds to say, I've got 20,000 users, has nothing to brag about. But if you say that, oh, I've got 20,000 users in a month with a $100 budget, now that's a lot to brag about. So it is really in relation to how much resources and how much money you have funding a company.
Yeah, that's a good point. It's all relative, isn't it? Great. Okay. Well, on that note, I think we're sadly out of runway, if I can use that apt startup phrase. A really big thank you to our star-studded panel tonight for giving us so much of your valuable time. It's been an absolute treat for me and for all those that have tuned in, I'm sure as well. For the audience, we will be announcing our next virtual event soon, so do keep an eye on the app at c-suite.sg to find out more. That's C-suite with a hyphen. You can also follow us on Twitter, Facebook, and LinkedIn to get updates about what we have coming up. As I've said on numerous occasions already tonight, please drop me an email at dean@csuite.sg if you have any feedback on tonight or indeed anything C-suite related. For now though, all that's left to do is to thank our esteemed guests one last time. So thank you everyone on the panel with some virtual applause and to say goodbye, and everyone have a lovely evening. So more from us soon. Bye for now, everyone.